should be recording now. Okay, so let's get started. So welcome, guys. This is just basically one of the lesson one of two for the relating to the free class I'll be offering for your CTA exam. So mainly targeting CTA 2 students, but most concepts can also apply to CTA 1. So in this lesson, we're going to do financial instruments. The next lesson will be revenue. As you know, most the topics was chosen basically by you. So, so financial instruments and revenue had the most votes out of all the other topics, topic suggestions. So that is why I've chosen financial instruments and revenue as the topics I'm covering for this free class. Okay, so now we're going to get started into financial instruments, right? So the structure would be, we just have 60 minutes. So the structure is, I am going to give you a high level overview of financial instruments, very high level, just to help your thinking. And then we'll go into a question and work through as far as we can. So the important items you need to know is that there are a number of standards where financial instruments is applicable, right? So you need to know that there is you have IFRS 9, you have IFRS 7, and you have IAS 32. Okay. Now, financial instruments in the real world is very complex, okay, very complicated. So for our purposes, it is complicated in our world, in an academic world as well, but not as complex as it is in the real world. Okay, so for IAS 32, when do you apply IAS 32? You need to know when IAS 32 is applicable, and that is when you have to classify a financial instrument. Okay, so basically IAS 32 is the presentation of financial instruments, and IAS 32 helps us with the definition of whether something falls within financial instruments. Okay, so with IAS 32, it will help you to determine whether something is a financial instrument, and then if it is, it will help you to determine how to classify, how to present financial instruments. Okay, so whether it is a financial asset, whether it is financial liability or an equity instrument. Okay, so this is extremely important. So yes, something can be a financial asset, but the critical part is the other side. Whether if you're on the other side of the transaction, whether it is a financial liability or whether it is an equity instrument. So that level of presentation is extremely important, especially for companies that have some debt and so forth. Because if they want to raise further capital, that type of classification is very important. Or if they do have debt, and in most cases when they take out loans from the banks, there will be covenants in place. Covenants are just basically certain conditions in a loan contract that states how much equity you can have, what's your capital structure, and so forth. And in the event you breach that, the bank can call on the money, right? Can ask you to repay. So that is why that is so important. So in our instance also, it's important to be able to classify a financial instrument correctly. So that is what the purpose of IAS 32 is. Okay. Then you have IFRS 7. Now I work in a finance department, right? And one of my key roles is like preparing financial statements when it is audit time. And like over the years, I was always like shocked as how much disclosure is always required. And in most cases, most of the queries relating to financial statements is not the income statement and balance sheet. It is actually the notes to the financial statements, because this note needs to be there, that note needs to be there, this word needs to be there, this number must be disclosed here. And a lot of these disclosures relates. I work in the financial services industry, right? So financial instruments is a big part of financial services. So the amount of disclosure that is required, and this is where I-47 comes into play. So for our purpose, once again, in the academic world, we actually don't go so hectically into disclosure, right? So when you have a disclosure question, you will make use of I-47. In the real world, I-47 is used extensively if you have financial instruments, and particularly if you're in the financial services sector, then I-47 you use very extensively. So that was you need to know when you have a disclosure question relating to IFRS to financial instruments, you will make use of IFRS 7. Then you come to IFRS 9, and this is where most of our work basically gets done in the academic world, right? We use IFRS 9. What do we use IFRS 9 for? IFRS 9 is used to recognize and measure a financial asset and a financial liability. Okay, it tells you when to recognize and how much to recognize, right? And also helps us to classify a financial asset. It also involves, for our purposes, dealing with impairment. So you or we in the academic world will be using financial IFRS 9 for financial instruments um, most extensively. Okay, so that is the standard we will use most of the time. But like I said, like in the real world, I suppose because we don't use when we studied, we don't really focus big time on disclosures. So it's really when in the real world when you're when you're preparing financial instruments, where your brain kind of gets used a lot when it comes to disclosure, because um, we don't focus on disclosures in our studies and in our daily job, right? It's just really when it comes to financial instrument, when it comes to preparing financial statements. So then disclosures is like kind of the big aspect. So so for our purposes, IFRS 9 is the biggest standard out of the lot. Then IAS 32, and then IFRS 7. So I'm going to jump into IFRS 9 and take you through the thinking process. Okay. So when you are dealing with a financial instrument, you have to first identify whether you're dealing with a financial asset or whether you're dealing with a financial liability or equity instrument. Okay. So if you for a financial asset, right, there will be three things that you need to do at initial recognition. So number one, you will have to identify when to recognize. Number two, you'll have to identify how much, and then or how to measure it at initial recognition. And then number three, you'll have to classify the financial asset. So this happens at initial recognition. Okay. So at initial recognition, when do you recognize? It's basically when all principal conditions are met, right? Um, so the person have the other party have fulfilled its principal conditions, and you now have access to what you have access to. So basically, and you have a right to all the principal conditions. So in that instance, at that time, so generally it's when the contract when the funds transfer, right? So it's mostly at that date. So for our purposes, when the transaction actually takes place and the funds transfer, that is basically initial recognition. That is the date when you recognize a financial asset. Now it comes to at what amount do you recognize, right? So this is very, very important to understand. No matter how you classify the financial asset, at initial recognition, you will always measure the asset at fair value, not at the amount that was transferred, not the amount that you paid to get the asset, but the amount, the fair value of the asset. So that's extremely important to take note. Okay. So if there is a difference between the fair value and the amount that you paid, then that will be a gain or loss that is recognized. So we call it a day one gain if you have paid less than fair value. If you have paid more than fair value, then it will be a day one loss. And this gain or loss is recognized in profit or loss. Okay, so that's important to take note. Then you will have to classify. Okay, so in terms of classification, you only have three options. Okay, it's either measured at amortized cost, or sorry, either classified at as amortized cost, or it is classified as fair value through other comprehensive income, or it's classified as fair value through profit or loss. Okay, so that's the three options that you have for amortized cost. What will make it amortized cost? You just need to have basically it needs to meet two conditions. Number one, it's held in a business model to collect contractual cash flows. Okay, so that is number one. The company's intention is to hold this asset to collect contractual cash flows. So the business model is hold and collect contractual cash flows. Number two, the contractual cash flows must only be the principal amount and interest. Okay, so if number one they hold this asset in a business model that only collects contractual cash flows, then it's tick. The second thing is, those contractual cash flows that they are collecting, is it only principal and interest? If the answer is yes, then tick. Then that means it will be it has to be classified as amortized cost. Okay, so that's important to take note. So if it's not amortized cost, so if it doesn't meet those two criteria and it's not amortized cost, then we will, and it's not amortized cost, then we are left with fair value through OCI and fair value through profit or loss. So check for fair value through OCI. There are only two instances where you can have an asset at fair value through OCI. Number one, it is very similar to amortized costs. What makes it similar? It's held in a business model to collect contractual cash flows. That's one, but there's an additional part over there. And so it's held in a business model to collect contractual cash flows. But this contractual cash flows is not two things, it is three things. It is for the to collect the principal amount. It is to collect interest, but it's also there. You also have the intention to sell it. Okay, so you are making money from the principal. You're making money from you're getting money from the principal, the interest, and then also a gain for selling the item. Okay, so that's your intention. Your intention is to collect contractual cash flows and then subsequently sell it. So if it is that, then it will be at fair value through OCI. Okay. The second instance, it can be at fair value through OCI if it is an equity instrument and you choose, or the word IFRS 9 uses, you elect. Okay, so you elect, meaning you choose to classify it as fair value through OCI. It's not required, but it is an election. Okay, so the only time you have this election if the financial instrument is an equity instrument. So you have invested in shares. So if you have invested in shares and you have the choice, you can elect to classify it as fair value through OCI. Okay, not a requirement, it's a choice. But what's important to take note, once you do classify it as fair value through OCI, it will be there forever. Okay, you can't change it. Okay. And then finally, if it's not amortized cost, if it is not fair value through OCI, then it will be fair value through profit or loss. Okay, so that is basically how is something classified as fair value through profit or loss. If it does not meet amortized cost, if it does not fit the criteria for any of the two fair value through OCIs, then it will be fair value through profit or loss. So what are the three things at initial recognition? Number one, when to recognize. Number two, how to measure, at what amount basically. And then number three, the classification. So that all happens at initial recognition. Regarding your transaction costs, if it's amortized costs, you will capitalize the transaction costs to the asset. Okay, If it is fair value through OCI, you will also capitalize the cost to the asset. If it is fair value through profit or loss, you will expense it immediately. Okay, so just take note of that. That's how you deal with transaction costs at the time. What's happening over here? So I don't have slides. I'm speaking from my head. Um, so Tandeka, I'm not using slides. Okay. Um, so just take note of that. Okay. So yes, I didn't prepare a presentation. I'm just speaking from my head basically. Um, so okay, so just take note of that. Okay. So I just lost my train of thought. Let's get back. Okay, so that is basically IFRS 9 at initial recognition. Okay, or financial assets at initial recognition. Then we come to subsequent measurement. Okay, so for subsequent measurement, what do we do? Subsequent measurement is all dependent upon our classification at initial recognition. So if it is amortized cost, we will amortize using the effective rate of interest. If it is fair value through OCI or fair value through profit or loss, we will simply get the fair values at each reporting date, and then any gain or loss. If it's fair value through OCI, the gain or loss goes through OCI. If it is fair value through profit or loss, the gain or loss goes through profit or loss. When it comes to amortized costs, the interest expense or the interest income for financial assets would go through profit or loss. Okay, so that's important to take note. What you should be aware of is that um, the when you have an asset classified as fair value through OCI that is similar to amortized cost, there will be two components. Okay, so it is similar to amortized cost, but we classified as fair value through OCI. There will be an OCI component, and then there will also be an interest component. Okay, so just take note of that. So that's important to take note. So that is basically subsequent measurement. Derecognition is highly complicated in the real world, but for our purposes, when we get rid of the asset, then we will just derecognize as per normal. Okay. Um, then for financial liability, what's important to take note for a financial liability, we will also recognize it at initial recognition as fair value. And a financial liability subsequent measurement will always be at the effective interest rate, and unless we choose to measure it um, at fair value through profit or loss. Okay, so just take note of that. You can designate it to go through that, but that is when you choose to do so. Okay, so but the general rule would simply be that we will recognize it at the effective interest rate method. Okay, the effective interest rate method is very similar to amortized cost. Okay, so just take note of that. So that's basically a very, very high level of financial instruments. Okay, so I'm going to jump now straight into the question, and then we will try to apply some of these principles as we go along. While I get the question is open, I just want to open up Excel. While I do that, if you have any questions, you can just ask, and then I'll try to answer as I navigate opening Excel. Do we have any questions? Yes, no, nothing. Okay, I'm going to share my screen. Okay, so you can see this, my screen over here. So this is basically a TAT letter 107 from 2022. Okay, so this is FAC 4863. It is a 2022 TAT letter. I can't remember the name. I think it's Fern Tech or something like that. So I know it's a bit different now with 4866, something like that. So I'm not sure if you get similar TAT letters like this, but in the past, the last TAT letter in FAC 4864 as well as FAC 4863, there will be like just basically case studies, right? So this is one of these TAT letters with case studies. Okay, so that's a 2022 one. I couldn't find the 2023 one that I have. I don't have 2024, but I did have 2023. I just couldn't find it. So I'm making use of, they already changed it in any case. So I'm going to do this question. It's nice and short, but lots of principles to apply over here. Okay, so I'm going to read it and then we'll work through it. If you have any questions, you can let me know. So let's say you have been appointed as the IFRS consultant for Swiss Ltd, a chocolate manufacturer that is listed on the Johannesburg Stock Exchange. Swiss manufactures different varieties of milk and dark chocolate and has branches all over South Africa. Currently, the company is trying to expand its footprint in other African countries. After extensive market research, it was determined that opening up a new branch in Zambia will assist Swiss to gain entrance in the African market. In order to finance the expansion, Swiss issued 5,000 debentures with a nominal amount of 11 million at a fair value of 2,000 Rand per debenture on 30th September 2019. Now, I just want to stop there, okay? There's lots of stuff happening in that sentence. So, you need to identify who are you, which side of the coin, right? Are you on the asset side or the liability side? So what's happening over here? You are issuing, right? So you are getting money and then you giving someone a piece of paper, okay, which is the debenture, okay? So in this case, you are giving a debenture and getting money in return. So the other party would have the investment, which will be the financial asset, and on your side, you are on the liability and equity side, okay? So as it stands, up until where we just read, we basically have a liability. Okay, so what we pick up over here is that we have issued 5,000 debentures with a nominal amount of 11 million at a fair value of 2,000. So the fair, if I say 2,000 times 5,000, that gives me 10 million Rand. Okay, so therefore, at initial recognition, we, we always measure at fair value. The amount is always at fair value and not the nominal value. So in this case, the nominal value and the fair value differ. Okay, so we would have, so you might just take note of that. Okay. So where are we doing this now? Okay, so the nominal value is 11 million and it is 10 million Rand. Okay, so per the debenture on 30 September 2019. Okay, so what you must take note, so at initial recognition would be on 30th September 2019. When do you recognize? 30th September 2019. Okay, because that is basically where we have granted them, we have given them the debenture and we have gotten the money. So take note over here. The money that we got was equal to the fair value. Okay, so the money that we received was equal to the fair value. So in that case, there's no day one gain or loss. Okay, because the physical cash was equal to the fair value. So you must be careful between fair value, the cash amount, and the nominal amount. Okay, we only make use of the nominal amount when we work out the interest. Okay, but when we are dealing with day one, when we're dealing with initial recognition, we must distinguish between the fair value and the physical cash flow. So in this case, the physical cash flow and the fair value is the same, as therefore there will be no gain or loss. There will be no day one gain or loss. Okay, so here they're telling us interest of 165 is payable quarterly in arrears, and the debentures will mature on 30th September 2023. Okay, so now we can work out the period. Okay, so the period would be from 30th September 2019 to 30 September 2023. So that would be 30 September 2020, that's 1, 2021, 2022, 2023. So that's a 4 years, okay? So that is basically 4 years that we are dealing with, that we will have this debentures in play. So now they're telling us each debenture is convertible at the option of the holder into 20 ordinary shares for every 5 debentures held. Debentures not converted will be redeemed at their nominal amount. Okay, so here we have a convertible debenture. Because the convertible debenture is it's at the option of the holder, we will have a liability component and an equity component. Okay, so we will have a liability component and an equity component because it is dependent upon, we're not sure whether it's going to be equity, whether we're not sure whether we're going to issue equity at the end of the 4 years or whether we're going to issue debt. It's at the option of the holder in this case, so we will split it out. Okay, so it's a convertible debenture, so therefore we will split it out between its equity component and its liability component. Okay, so they say on 30th September 2019, the transaction costs of 800,000, I'm assuming it's a rand, were incurred by Swiss. Any transaction costs incurred on the issuance would be deductible for tax purposes in the tax year in which these costs are incurred. A market-related interest rate on 30th September 2019 for similar debentures without conversion rights is 11% per annum, paid quarterly in arrears. Okay, so there we will have to use that. I'll explain how we use that. So just take note of this. Yeah, this is deductible for tax purposes. Why? From SARS's perspective, you are issuing debt. Okay, so from SARS's perspective, you are issuing debt. As such, because you're issuing debt, you will be able to, and the debt is to fund a operations, right? You're doing an expansion. So therefore, it's in the ordinary course of what income in trade, whatever they call it. So therefore, it will then classify as being able to be deductible. Okay, so they're just telling you that. Okay, so now I'm going to switch over into into Excel, but let's just quickly read the required. The required is somewhere here. So here, take note what they did. Okay, so I'm not gonna in this question they're gonna ask us to fix what they did. Okay, so that's very important in an exam. I'm going to do the normal transactions, how it should have been done. You wouldn't get marks if you do it the way I'm going to do it. In this particular paper, you won't get the marks for it because they're asking us to do correcting entries. Okay, so that's very important. I just want to take you through how it should have been done. Then you can have a look for yourself how it was done and then do the correcting entries. Okay, so that's very important in an exam to make sure to answer the particular question. So I just want to go to the question and share it with you quickly. Let me just do that. So here they say, prepare the correcting journal entries to account for the issue of debentures by Swiss for the year ended 30th September 2019. So the only one for that year, we issued it on this date. So therefore, we only have to do initial recognition. Okay, so that's the what you must pick up over there. So include journal entries relating to current and or deferred tax, journal entry are not required around all amounts of the nearest rand. Okay, so just take note over here. They want correcting journal entries. I'm not going to do the correcting journal entries. I'm gonna do the journal entries how it should have been done. Okay, then you guys can do the correcting journal entries by saying what was done versus what should have been done and the difference. Okay, and then take note, they only want it for the year ended 30th September 2019. So that means all journal entries relating to this debenture for that year ended. But what do we know? We only issued it on 30th September 2019. So therefore, they're indirectly telling us do the initial recognition journal entries. Okay. So I'm not going to do the correcting. I'm going to do how it should have been done, and then you can figure out the correcting. Okay, so I'm going to go back up, and then I'm going to switch over into Excel. Okay, so you should be able to see Excel. Okay, so at initial recognition, what we should have recognized is the following. Okay, so yes, we received cash. Okay, so that's going to be the easiest. Okay, so we received cash. So yeah, I want to do this quickly. So debit and credit. You should be able to see Excel, right? I'm assuming. Account statement. Okay. We don't need the first column, but I'm just going to do it. We don't need the first column. Okay, so we don't need the first column. We don't need the date. They didn't tell us. Okay, but I'm just going to put in the date. So this all of it's going to be on 30 September 2019. Okay. So remember what happened. We have issued debentures, and so we gave debenture notes, piece of paper, in exchange for cash. So it would be debit. So cash, we have received cash. Cash is increasing. Cash is an asset. Assets increase on the debit side. So we're going to have bank. The statement is SFP, and we received money, right? So it was 2,000 debentures, and we went to record the cash amount that we received, not the nominal amount, not the fair value amount. So it's the cash amount that we have received, 5,000 debentures multiplied by the cash amount. In this case, the cash amount happened to be equal to the fair value. So therefore times 2,000. So when we equal to 5,000 debentures times 2,000 Rand. Okay, so that is the amount that we should have received. 10 million Rand. Now, if this was not a convertible instrument, we'd have said credit debentures 10 million. But in this case, it is a convertible instrument, so therefore we'll have two parts, an equity component and a liability component. Okay, so basically we will have debenture. So here we will have debenture. Debentures, and this is liability component. And we will have debentures, and that will be equity component. Okay, so just take note of that. If this was not a convertible instrument, then it would simply have been credit debenture. But because it is a convertible instrument, there will be two components. Okay, so now we're going to work out the components. So the first part is, let me just do this quickly. Okay, so we have our workings. Okay, so I'm going to do our workings over here. So okay, so working one. So all we have to do is, in order to get the liability component, we must work out the present value of the debenture at initial recognition. So we need to work out the present value of the debenture at 30th September 2019. Okay, so what do we want? Present value. So we're going to need the future value. We're going to need payment. We're going to need N, and we're going to need I. Okay. So this is what we want. Okay, so we want the present value. Okay, so that is basically what we looking for. Okay, so we want the present value. So that means we need everything else. Okay, so the future value is the lump sum payment at the end. Okay, so if they don't convert into ordinary share equity, we will pay the nominal value. Okay, so they said if they don't if the holder do not convert into equity instruments, then we will pay them back at the nominal value. We know the nominal value is 11 million rand. Okay, so we know the nominal value is 11 million rand. The payment, they gave it to us. It is 165,000 rand. So the payment is 165,000 rand per quarter in arrears. Very important. This is a quarterly payment in arrears. Okay. So what is N? N is basically number of payments per period multiplied by number of years. Okay, so number of payments, let's call it per year, multiplied by the number of years. Okay, so we know how many years this debenture is in place. Is for 4 years, and the number of payments per year, it's quarterly, so therefore it is 4 payments per year. So because it's quarterly payments, it is 4 payments per year multiplied by the number of years, which is also 4. Okay, so it is 16. Then this needs to be the market rate without conversion rights. Okay, so the market rate without conversion rights. They told us the market rate without conversion rights is 11%. Okay, so therefore this is going to be 11%. Okay, so what's important to take note though is the following. Now this 11% is a quarterly amount per annum, right? But we need to make sure it's in line with N, so we need to divide that by 4. Okay, so effectively it's 3%, whatever it is. Okay, so let's just do that. Okay, so it's 2.75 per it's 2.75 per quarter. Okay, so now we can work out the present value. So I'm just going to use the formula present value. They want the rate, which is 2.75. They want N, which is 16. They want payment, which is that. And then they want the future value. And they want future value to be that. And then the type. So the type is whether it was end of period, meaning in arrears, beginning of period, meaning in advance. It is in arrears, so we make it 0, close. So there we go. The answer is that. Okay, so it is 9 to whatever the number is. Okay, so that is the amount. They'll put it in negative. That's just how the formula works. Future value and payment is always in the same direction. Future value and payment is always in the same direction. Present value will be in the opposite direction. So because I had these in positive, that will be negative. Okay, so that is the answer over there. So the liability component is simply going to be equal to that. Okay. Okay, so there's working 1. Then working 2, just to show you how we get the equity component. So working 2, it will simply be proceeds less present value of liability. Okay, and then this will give us our equity component. Okay, so our proceeds, we know it is 10 million. Okay, the liability component is that, so therefore the equity component would simply be the difference. Okay, so that is my equity component. Okay, so that is basically working. That is basically working too. Okay, so just to do a check, just so you can just have a look, just so you can have a look that the two need to add up. Okay, so here we go, 10 million, 10 million. Okay, so just so you know, that is basically how that will work. So what is the principle? Just give me a moment quickly. My son just sneaked in. Okay, so basically the principle over here is at initial recognition, we will get the cash amount. Okay, over here, we will recognize based on fair value. Okay, so we have to recognize based on fair value. So the liability component is measured at fair value, but what's important over here, it's fair value. This rate we use is the market related rate, excluding the conversion. Okay, so that's important to take note. And then the balancing figure goes to equity. Okay, so we know we need two parts because it's a conversion rate. We have to have two parts, liability, equity. So important to take note. We first work out the market related rate for the debenture, excluding conversion rights, and then the difference goes to the equity component. Okay. The last part I want to cover over here, the last part that I want to cover over here the last part I want to cover over here is basically the transaction cost. Okay. So what I want to cover is the transaction cost. So take note regarding the, so you might just take note regarding what they did over here. They said credit liabilities 11, and they said, I think I can't remember what they actually do. So you might just have a look what they did and then just do the difference between the two. Okay. Now the transaction costs, I think they went debit, they said debit, transaction costs, profit or loss, credit bank. Okay, so yeah, the credit bank is correct, but taking it to P&L is not correct. Okay, so what they should have done is the following. Okay, so same date, okay, we would have paid transaction costs, so we will say bank. Okay, so we'll pay bank SFP 800,000. Okay, this is given. Okay, so 800,000. Okay, so that is basically given 800,000. Now, what all we have to do is split that 800,000 between the liability component and the equity component. Okay, so all we're going to do is the following. We can go So if we have a working 3, okay, so the liability is basically that, the equity is that. Okay, so we have the total. Okay, so we just get the percentage. We're just gonna basically, all we're basically doing over here is what do you call it? We're just apportioning it basically. Okay, so the transaction cost, which is 800,000. Okay, so that is basically how we will split the transaction costs. Okay, so if I must add this up, should come to 800,000. Okay, so there we go. So we don't take it to P&L. It's not, it can only go to P&L if it's fair value through profit or loss. So if it's a financial asset, then we can consider P&Ls and stuff. A financial liability to go to reduce the financial liability, and then the equity component as well. Because it's relating to an equity component, remember, an equity transaction can't go through profit or loss. A transaction with the owner can't go through profit or loss. It has to go directly through the income statement. Okay. I mean, it has to go directly through the statement of change in equity. Okay, so just for this one, just to make it like that, perhaps. Okay, so then I'm just going to do this. Okay, so all this is going to do is simply do that. So that is basically that aspect. Okay, so remember the equity component can never go through, the equity components can never go through the profit or loss, because only transactions with, remember, owner transactions cannot go through the profit or loss statement. Owner transactions always go directly through the statement of changes in equity. Okay. Then the liability component, transaction costs relating to the liability will also be impacted by the liability. Because we're using the effective interest rate, it impacts the value of the liability. Okay, so just take note of that. So so there we have it basically. That's all I wanted to cover today. So I'm going to do this as well. So just some important principles to take note. You don't have to do this, eh? In the exam, don't waste your time doing this. But do make sure your thing is balancing, because you lose all your marks in a journal entry if your journal entry do not balance. Just take note of that. So if you don't know the other number, just make up a balancing figure, just to make sure that so if you're happy, let's say you could work out one number, but but you still can't figure out a balancing figure, what it relates to, just put in a balancing figure. I don't know what you want to call it, so that your journal entry balances, so you can at least get the marks for the other stuff that you have calculated. Okay, so that's very important to take note. Okay, so what are the important principles over here? At initial recognition, we recognize the cash that comes through. Okay, in terms of recognizing the liability, the liability will always have to be at fair value. Okay, the liability will always have to be at fair value. Because we had a convertible option. The balancing figure goes to the equity component. What's important to note, how did you calculate this fair value of the liability? Is by using a market-related interest rate, excluding the conversion rates. Okay, so that's very important. The market-related interest rate excluding the conversion rates. Okay, then the transaction cost. The transaction cost can't go through profit or loss, especially the equity component, because the equity component is a transaction with the owner. Any transaction with the owner cannot go through profit or loss. It has to go through directly through equity. Okay, so just take note of that. Okay, so that's it from my side. Is there any questions on your side regarding this particular question, or any financial instruments related question? So I'll stop sharing over here. Any questions you guys had? Yes, no? Abonga, Avishni, Boitumelo, Dumfo, Lawrence, Leah, Manda, anything?
Hi, Fires.
Yeah.
Yes, I just wanted to know on the market interest rate, is it always the option without conversion? Always.
In a question like this, yes, yeah, but generally is always yes.
Thank you.
Okay. Neko, Shawl, Tandeka, anything? Nothing? Okay.
Please can you show us the journal entries at year end?
That is the journal entries.
It's year end.
Yeah.
Oh, okay.
Remember the at 30th September 2019, that's when the transaction took place. So that is financial year end. Yeah.
Oh, I was hoping to see interest, expense.
Oh, that would be for 2020. That would be for financial year in 2020, not in this current financial year, because at 30th September 2019, it was initial recognition. But I can't do it now, but I'll see if I can do it when I share it. I'll give a mock about what you do. Okay.
Thank you. Please can you share your notes?
Sorry, please can I share what?
The example that we've done in class.
Yes, this one I will share it, yes.
Thank you.
I'll share it now. Okay, I'll put in the group now. Then I know it's there. Then I'll put in the I'll share the recording once it's done. Okay. Okay, guys. Thank you very much. I will let you know regarding the revenue one. I'm gonna aim for tomorrow, but if I can't make it for tomorrow, because I'm dealing with some of the auditors, then I will do a recording. Okay. Okay, so I hope you find it beneficial. I hope you find it useful. So that's it from my side. I will share you. If I don't get to the revenue one, then if I don't get to if I don't get to the revenue one in terms of a live class, I will do a recording. But hopefully I can do a live class. And then yeah, so that's it from my what I will be running for the exam period is I won't be running live classes, but I will be doing a video course recorded, working through two to three the past exam question papers. I think I have 2023 December 2022 and January 2023. I think I have that. So yeah, I have those. Okay, so I have some to work. So I'll be recording those. It will be for sale. So it's going to be for both Mac and FAC. So FAC 4863, FAC 4864, and Mac 4862. So those three question papers. I'm going to check the dates now. I think that's I have December or the October exam 2022, and then the January sub exam 2023. So that is I'll be recording. That will be ready. The first set of questions will be ready by the weekend, and then the whole program will be completed by mid-September. Okay, so if you're interested, you can just let me know. But that will be a paid offer. Okay. So yeah, I'll see you soon. Hopefully tomorrow. If not tomorrow, I'll send you a recording of the revenue question. Okay. Bye bye.